the process for developing a retirement income plan? Should you use the 4% rule? Well, here to talk with me about that is Bill Bengen, who 31 years ago wrote a paper that changed the course of history for retirement income planning and who is about to publish a new book coming in August, the title of which is A Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More. Bill, welcome to Decoding Retirement.
Hey, great to be here. Thanks for inviting me.
Oh, it's a pleasure to chat with you, Bill. And I'm wondering if you could begin with the process of creating a retirement income plan. I know in your book you say that there are 8 customizable elements. Let's go through them.
Yeah, okay, fine. I think it's important to do that because a lot of folks get hung up immediately at the start with what's my number? Is it 4%? Is it 5%? And there's a lot of things you have to look at before you can get that to that point. The 8 customizable elements I developed start with what I call the withdrawal scheme. And most people aren't aware that underlying the 4% rule, which is now the 4.7% rule, I've upgraded it, is a mathematical definition of the way in which you're withdrawing money from your retirement account. And that particular rule used for the 4.7% rule is you start the first year, say you have a $1 million IRA account, which would be nice, and we going to withdraw 4.7% the first year. That'll give you a $47,000 withdrawal the first year. The second year, you throw that 4.7% away. You never think of it for the rest of retirement. And just like Social Security, you give yourself a cost of living adjustment. So if inflation was 10% the year before, you increase that $47,000 withdrawal by 10%. And you do that each successive year, just keeping track of inflation and adding. And the idea is to keep your withdrawals close to the level of inflation, maintain a lifestyle, so to speak. That's not the only scheme. There are lots of others, and I list them in the book. Percentage of assets, a fixed annuity, and another one I think could be popular with retirees is a lot of folks like to spend more early in retirement and then cut back, let's say, in about year 10. That's a whole nother approach, and the numbers are different for each and every withdrawal scheme. So you start with that. That's very important. The second one is your planning horizon. That's related to how long you're going to live, and if you have a spouse, some kind of a joint, life expectancy. But you don't necessarily want to plan to spend your last dollar with your dying breath because most of us can't get that timing down that well. It's difficult. So I recommend you put in a margin of error, maybe 30%, approximately 10 years. To give you a chance, and don't be afraid to go more. The way people are living to 100 or more nowadays, you don't want to be having to readjust this thing somewhere in your mid-90s. You'd want to take care of it when you retire.
Right. So before you go on, Bill, I'm curious
Sure.
about life expectancy. Many financial planners today are suggesting that you use age 95 as sort of the planning horizon. Do you think someone should use life expectancy or a planning horizon that exceeds life expectancy?
I definitely something that would exceed life expectancy because life expectancy is an uncertain computation. There's so much uncertainty in this. I give yourself a margin of error, just like when they build bridges. They build a 3-to-1 margin of error, 4-to-1 in there. Do that for yourself, and you'll thank me later, as Monk used to say. The third element is: are you taking a taxable or non-taxable portfolio? That makes quite a bit of difference. Once again, that 4.7% rule is based on a non-taxable portfolio, like an IRA. But if you have to pay taxes during retirement on your gains and your interest and your dividends, that's going to whittle away at your principal, and therefore your withdrawal rate will be significantly lower. The higher the tax rate, the more of a penalty you pay in taxes. So you have to take that into account.
Yeah, so does that mean that you would adjust upwards the withdrawal rate from 4.7 to 5 to accommodate the after-tax?
For a taxable account, you have to go the other way. You have to reduce it.
Yeah.
Because the taxes the government is going to take some of your retirement with it. So it's definitely a big consideration.
Yeah. So, Bill, I'm also reminded of the fact that many people have their money in a IRA or a 401k, and sometimes they forget that if they have $1 million in their account, it really only nets out to $700,000 because the government takes 30% of it or whatever the percent might be. So
That's right.
Yeah.
That's true. And of course, in my research, I don't necessarily look at that. I look at only what happens while the money's in the portfolio. Whatever happens afterwards, I leave to fate and destiny. That allows me to treat a taxable portfolio and a tax-deferred portfolio the same way. Basically, a tax-deferred portfolio is a taxable portfolio with a 0% tax rate. So I can treat it consistently that way. The fourth element is, do you want to leave money to your heirs? Once again, one of the underlying assumptions, often not mentioned with a 4.7% rule, is that the balance will be zero at year 30 or whatever the last year of your planning horizon is. Let's say you want to leave a substantial balance. Well, you have to do a calculation. It will reduce your withdrawal rate, and it will reduce it pretty substantially. So there is a high price to pay to make your heirs happy, and you have to trade that off against making yourself happy during retirement. So that's a discussion between you and your financial advisor.
Yeah, there's a popular book, by the way, right? Die with Zero, and people are fond of saying that I want to make sure that I spend all the money on myself, on my desired standard of living, as opposed to like leaving behind more money than I wanted to my heirs.
Yeah, it's a very individual thing, and every person has to make that decision for themselves. But it's a decision that has to be made. You just can't leave it to chance. It will affect your withdrawal rate.
Right.
Element number 5 is asset allocation. This is just a huge topic. I can't even begin to stem, the top of it. But how you set your investments up is very important to what your withdrawal rate will be. Fortunately, there's a plateau between about 47% stocks, about 75% stocks. If you stay in that range and the rest in bonds and cash, you'll end up with about the same withdrawal rate, about 4.7% or whatever you choose. If you go less than that or more than that in stocks, you're going to probably suffer with reduction withdrawal rate. And that's assuming you want to keep a fixed asset allocation during retirement. There are also schemes whereby you can vary it, something called a rising glide path, where you start with a lower allocation and increase stocks. In my book, I show that actually adds to withdrawal rate counterintuitively. And there are a lot of other schemes using guardrails and reductions when markets do poorly. So it's a vast topic and a very interesting one.
Yeah,
something you have to make a decision on.
Yeah. So in your book, I think you talk about using 55% stocks, 40% bonds, and 5% cash. Is that sort of?
Yeah, I use that as a good intermediate thing. Yeah. Right.
Yeah. And I'm curious, Bill, it sort of brings to mind this notion that I talk to a lot of advisors and a lot of retirees who oftentimes say that they've ended up with more money at the end of their retirement than they began, in part because of portfolio growth and their withdrawal rate being below the portfolio growth. Is that something that you encountered in your research by chance, or?
Absolutely. It's a critical topic. In fact, that was one of the harshest and probably most justified criticisms of the original 4% rule when it came out. If you use the 4% rule or 4.7% rule was designed to be a worst case scenario. It only fits one individual, one retiree out of hundreds of retirees in the last 100 years. It's a worst case. Everyone else was able to take out more. If you take out at that low rate and you don't meet those worst case situations, the money's just going to pile up during retirement. And probably later in retirement, you're going to have some regrets, wondering whether you should have and could have spent more. So one of the key things I develop in my book is a scientific way to get the highest withdrawal rate you can without taking any risk. And for most people, it's not 4.7%. It's higher. And in some cases, much higher. Over the last 100 years, believe it or not, the average has been 7%. Told people are so used to talking about 4 and you hear 7, you say, that's crazy. But no, that's been the average. We haven't seen much of the average the last 25 years. And the last time was 2009 when the market bottomed. And that particular retiree, probably close to 8%.
Yeah.
And they're doing well. But that's one of the few above average or even close to average we've had, in many years.
So I do want to get to elements 6, 7, and 8, but you mentioned the word risk, and to me, the moment you mentioned risk, I think of sequence of returns risk, and oftentimes people say that if you're withdrawing 4 or 4.7% in the early years of retirement, you may find yourself depleting your portfolio or reducing your standard of living later in life because of that sequence of return risk. Any thoughts about that?
Well, that's based on a misunderstanding of how the 4.7% rule was computed. That was actually developed with a situation where there were two huge bear markets early in that individual's retirement. So that's taken into account. That's why it's a worst case scenario, in addition to the high inflation, which kept bumping up, withdrawals. So if you're following the 4.7% rule, you basically incorporated the worst things that have happened over the last 100 years, including multiple bear markets, early retirement, high inflation. And hopefully we don't encounter something worse than that anytime soon.
All right, Bill, we have to take a short break. And when we come back, we'll pick up with elements 6, 7, and 8 and talk about some other topics. Don't go away. Welcome back to Decoding Retirement. I'm talking to Bill Bengen. He is the author of a soon-to-be-published book called A Richer Retirement, Supercharging the 4% Rule to Spend More and Enjoy More. Bill, when we left off, we were about to tackle the rest of the elements that people need to consider in building their retirement income plan. I think portfolio rebalancing is next up.
That's correct. Yeah, and it's an important topic that most people forget about. I call it one of the 4 free lunches available for retirees to increase your withdrawals. Portfolio rebalancing just basically means returning your investment portfolio to its original asset allocation after some predetermined length of time. And there are a lot of ways to do it. Some people just do it wholesale once a year. We start with 60-40. Let's go back to 60-40, stocks and bonds. Some people test each asset class individually and make sure they stay within a certain range. Once one class exceeds that range, they just bring that asset class back in. And a lot of variations to that. But portfolio balancing frequency is important. 1 year seems to be the optimum to my research, but I can tell you it will vary dramatically over. There are some cases where you could have earned a high withdrawal rate by not rebalancing at all. And other times you would want to rebalance every quarter. And it's just impossible to predict that. So 1 year seems like a reasonable compromise and works, in the vast majority of cases. And it's important because it prevents the portfolio from getting overweighted in risky assets like stocks and getting so volatile, that if you hit a stock bear market, it gets completely destroyed.
Right.
So that's critical risk management here.
So I'm curious, Bill, with respect to rebalancing, there's a school of thought that says you should decrease the percent that you invest in stocks as you age so that the portfolio becomes less risky. You're suggesting that it's a static portfolio over the course of retirement in order to sort of keep this withdrawal rate at 4.7% as opposed to reducing your allocation to stocks.
Yeah, there are 3 choices: reduce stocks, maintain them, or increase them. And of the 3, the worst is to decrease your stocks. And I tested that early on in my research, and I found out that actually reduces your withdrawal rate. It's the one thing you do not want to do. The next best is to maintain a fixed asset allocation during retirement. And slightly better than that is start with a slightly lower allocation, like 40-60, and then gradually increase that over time. And that seems to work to increase your withdrawal rates slightly.
Yeah.
So that are the 3 options.
What about element 7?
Okay, element number 7 is, are you Warren Buffett? I underneath all the research I've conducted is the assumption that we'll be investing in index funds. We're basically just attempting to get, for each asset class, the actual market return. We're not trying to beat that return. If we have an S&P 500 component to our portfolio, that's what we're trying to get. We're not trying to beat the S&P 500. However, if you think you're good enough to do that, I've got a section in the book which calculates how much your withdrawal rate will increase for each, let's say, 1% gain you make in returns. It also shows you how much you'll lose in withdrawal rate if you fail in your goal, and that's a real concern. So I think unless you're an exceptional individual, and there are some individuals that can beat the market, Uh, you may want to stick with index funds, but if you want to take a look at it, it's in there.
Yeah. So then with respect to withdrawals, a lot of times I talk to retirees and they suggest that they want their check on a monthly or every other week basis coming out of their accounts. But in your book, you talk about the timing, sometimes the timing taking it all in a lump sum at the beginning of the year or all taking it in a lump sum at the end of the year. Or what's your take on how to withdraw money?
Oh, most people probably take money out on a monthly or semi-monthly basis. That's fine. My research that I in the book assumes it'll be done evenly during the year. I actually did a calculation beginning of the year and an end of the year and averaged it, and that represents evenly spaced withdrawals during the year, whether it be monthly, bi-monthly, or so forth. And that's fine. If for some reason you're going to take all of it out at the end or all of it out at the beginning, then you're going to have a different number. And it'll
Right.
be significantly different than the 4.7% or whatever number, which results from an evenly dispersed withdrawal pattern.
Yeah. So those are the building blocks, but there are other things that we can discuss about building a retirement income plan, including what's
Yeah.
the stock market valuations and the inflation regime.
That's right. Once you've basically decide on values of those 8 elements which suit you, they're customizable. You still need to consider 2 more elements, 2 more factors or variables before you can come up with your so-called number. And early on, Michael Kitces in the early 2000s, he's a well-known financial advisor, does a lot of publication, brilliant guy, produced a chart which amazed me. It basically took the PE of the stock market and year by year and charted it against the withdrawal rate, the safe withdrawal rate for that year. And it's pretty amazing because as the stock market got more expensive, the withdrawal rate came down. And as the stock market got cheap, the withdrawal rate would go up. And of course, that's the reason for that is when the stock market is very expensive, you're probably pretty close to a major bear market. And we know a major bear market in retirement reduces withdrawal rates and the opposite, conversely. So I was stunned by that chart, and I was hoping that chart would solve this difficult problem I had had for years, recommending a scientific basis for recommending to clients and individuals how to access those juicy high withdrawal rates from the past. But unfortunately, it was a brilliant insight. It just didn't have quite the strong correlation needed. So about 3 years ago, I was able to work inflation into it. And between using inflation at the time of retirement and stock market valuation at the time of retirement, we can select with confidence a withdrawal rate that accurately reflects what's happened in the past and hopefully in the future. So when the time comes and 7 and 8, 9% withdrawal rates become realistic, we'll have a tool to identify them and apply them. Right now, though, we're kind of stuck in the low 5s, which is discouraging. It's been like that for a long time.
So, Bill, I'm curious, as I think about building retirement income plans, one of the things I think about is, let's say the number I need is $100,000 to support my lifestyle in year 1 of retirement. I'm getting X, maybe $50,000 or $60,000, my wife and I, from Social Security or from pensions. And I need to get the rest from withdrawals from my portfolio, be it my 401k, taxable accounts, Roth IRAs, et cetera. And so that means the number is, call it $40,000 as a start. And at the moment, I don't know what the percent is, but that's the number I need to maintain my lifestyle. Is that a starting place for people or?
Yeah, it could be a starting place. The next question is whether your portfolio is large enough to support, sustainable withdrawals of that magnitude. That's what my research is all about.
Right. So in the case of your research, if I had to withdraw $40,000 from my portfolio and I had a $1 million portfolio, that would seem to suggest that that portfolio could sustain that withdrawal rate for 30 years.
Oh yeah, you're in happy city there. That's 4% withdrawal rate. You're looking good. I would take a total catastrophe in the markets, beyond anything we've experienced in the last 100 years to upset that apple cart.
What about other retirement income approaches, Bill? The bucket approach is a strategy that many people favor. Floor and upside, or asset liability matching, or other techniques that people ascribe to. Any thoughts about how people would consider which approach to use?
Yeah, the bucket approach, I haven't actually tested that. I've read some articles, particularly one by Michael Kitces, which were not too complimentary about that approach. I can only say from reading Michael's research, which is highly reliable, I would tend to think doesn't contribute much, in my opinion. But I haven't tested it myself, so until I do, I don't want to be 100%, confident with that.
Right.
As far as other approaches like a floor and ceiling approach, I discussed that in my book. That's something folks can use if they feel they want to take a little risk and maybe use a higher than recommended withdrawal rate. That way, the floor and ceiling approach will scale back your withdrawals when things get nasty in the stock market unexpectedly. That should work. But yeah, my focus is on finding the right withdrawal rate. My belief is that if you find the right withdrawal rate at the beginning, your adjustments during retirement shouldn't be as large as they would have been if you started with just the 4.7 or the 4% rule.
Right.
That's why I spent so much effort on that task, to
Yeah.
eliminate the need for later adjustments.
So, Bill, we've covered a lot of ground. Anything we missed, or anything that just bears reemphasizing?
If you have another 3 hours, yeah, but no, maybe next time we can talk a little bit about managing your plan, because that's crucial. A 30-year plan is going to encounter problems just like anything else, and how you deal with them is really important to the success of your withdrawal plan.
Yeah, I mean, I think that's a good place to end our discussion, which is this notion of it's not a set it and forget it plan. It's a plan that you monitor and adjust as you go. I'm reminded of Jonathan Guyton's dynamic withdrawal strategies, where he says that there may be a need to sort of readjust things to ensure that you have longevity of your portfolio.
Yeah, I have some really interesting thoughts to share with your listeners, so next time I'll be happy to talk about that.
All right. Bill, I want to thank you ever so much for sharing your knowledge and wisdom with us. It's so greatly appreciated. I can't wait to have you come back on and talk more about the 4.7% rule and other topics as well. So thank you. Much obliged.
Thank you. I really had a great time.
Great. So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to better plan for or live in retirement. And don't forget, if you have questions about retirement or money, we're here to help. Email me at askbob@yahooinc.com, and we'll do our best to answer your questions in a future episode.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.